The search engine results page has fractured. AI overviews are swallowing up research queries, while paid ads capture the transactional clicks. This chart shows the impact. Classic organic click share across major verticals dropped 23%. Right next to it is the baseline for AI-assisted traffic. Over 2 years, traffic from these generative AI platforms grew by 796%. The wireframe of a 2026 search results page shows why. Blocks of ads and AI overviews dominate the top of the screen, pushing organic links down, often entirely below the fold. For commercial searches, when a user is actually ready to buy, paid placements now capture 36% of all clicks. With the top of the page monopolized by paid placements and AI features, traditional organic search strategies no longer guarantee visibility. For New Zealand businesses, geographic isolation means dealing with a smaller total addressable market, or TAM. TAM is the maximum potential revenue a business can generate if it captures every single customer in its specific market. A smaller TAM creates a hard ceiling on search volume. Because there are fewer people searching, maximizing budget efficiency and converting every possible visitor is critical. You can evaluate these digital marketing investments through a specific financial lens. You are either paying rent or you are paying a mortgage. Paid ads are your rent. You pay them for immediate survival, rapid data gathering, and guaranteed placement at the top of the page. SEO is your mortgage. You pay to build a compounding digital asset over time that eventually earns citations from AI overviews. Success for a Kiwi business depends on sequencing these investments based on immediate cash flow needs. Pay-per-click advertising requires an immediate, continuous cash burn and active daily management. In return, you get speed. You secure instant visibility and can generate leads within hours of launching a campaign. This line graph illustrates the financial limit of PPC. There is a steep, immediate upward spike in traffic, flattening out around 200% ROI as cost-per-click rates rise. The trade-off is traffic and lead generation drop to absolute zero the moment your funding stops. While PPC is excellent for injecting immediate cash flow, it is a rented strategy that provides no long-term business equity. SEO requires a different timeline. You must invest for 3 to 6 months in technical site health and content creation before seeing progress. During this initial investment phase, businesses typically see almost no immediate financial return. This period is used to build EEAT signals. EEAT stands for experience, expertise, authoritativeness, and trustworthiness, the specific markers search engines require to rank your site. This J-curve graph shows the payoff. After a period of flat growth, the returns accelerate, generating a 748% average return on investment over a 3-year period. At the top of the curve, high-quality content earns verified citations directly inside generative AI overviews. Users referred by these AI citations convert at a 1.2 times higher rate than traditional organic traffic. SEO is a highly profitable, compounding digital asset. However, the upfront capital and patience required means it cannot save a business that needs revenue this week. For New Zealand trades and local service providers, the focus relies on optimizing your Google business profile and local directory citations. Instead of broad national terms, the strategy targets highly localized keywords like electrician Wellington. This search interface demonstrates why local search is unique. Securing a position in the local pack, the map and top 3 listings, places you above the AI overview section, providing a secure strategy against disruption. The trade-off is that local SEO strictly limits your reach to narrow geographic boundaries. Because local traffic is volume capped, you must achieve high conversion rates on the limited traffic you do receive. Dominating the local pack is a secure, durable strategy for local NZ trades, provided they can efficiently convert their hyperlocal audience into paying customers. This is exactly how a New Zealand startup should strategically phase their digital marketing investment during their crucial first 2 years. In the startup phase, we prescribe a split, 70. You then feed this verified conversion data into your long-term SEO content plan to avoid targeting organic keywords that don't produce revenue. For startups, PPC is a research mechanism used to fund and accurately guide your future organic foundation. For established New Zealand B2B companies and professional service providers, the priorities change. The budget allocation shifts to 30% PPC and 70% SEO. B2B buyers have long sales cycles. They use AI to build shortlists over months of research. Establishing organic authority and inclusion in those AI overviews acts as a defensive competitive moat against new market entrants. Established B2Bs should restrict their PPC usage to retargeting campaigns and protecting their own brand name from competitors. These companies prioritize SEO to secure their presence in AI-assisted research, utilizing minimal PPC only to capture intent at the bottom of the funnel. Finally, we have the landscape for local New Zealand retail and e-commerce players. For e-commerce, the allocation is perfectly balanced, 50% PPC and 50% SEO. AI overviews now fulfill top-of-funnel informational traffic, making generic e-commerce buying guides ineffective. E-commerce businesses should allocate their SEO budget exclusively to technical product page optimization to ensure fast load times and clean data architecture. Using paid ads, specifically Google Shopping, is a necessity in the retail sector. Paid results now capture over a third of all commercial product clicks, making ads a requirement for e-commerce survival. Allocate your budget based on your immediate operational timeline, buy traffic to survive today, and build the authority needed to stay profitable tomorrow.